resources sector is comparatively small, and Mandalay plays it very differently from the way Royal Road or Tim's predecessor companies have played it. We are actually a value-focused producer, and we have a proven turnaround strategy for success. So we actually stay away from exploration and focus on buying distressed assets, turning them around, and bringing 3 to 5 times the acquisition price into a net asset value within about 3 years. We've done this 3 times in the last 7 years, and you'll see the results coming up. So to do this kind of work, I think you'll see that Tim and we have come to the same actual relationship with values and sustainability. We have to be focused on a multi-perspective devotion to assuring value for all our stakeholders, certainly employees, certainly communities, environment, customers, and if all 4 of those perspectives are in good shape, the shareholders make out pretty well. But while the shareholder value is the end goal, it has to go through all the other 4. So what do? We acquire undervalued mines in transactions that are accretive to our shareholders at the time of the deal, and then we turn them around to crystallize increased value in the market, and somehow, and we've done it in many ways, return cash to shareholders when these assets are hitting on all cylinders. So the first point is acquiring producing or near-term assets that are at a discount. We have specialized. None of our 3 acquisitions have had any competition. We are seeing value where others do not, and consequently can negotiate quite good entry prices. What we do is we see a history of underinvestment in sustaining capital that really limits current performance. For instance, underground development rates to open up new ore bodies, or stripping to reveal new ore in open pits, maintenance, equipment availability, and so on. We actually have a specialty of introducing major improvements in mining methods from manual, relatively unsafe methods with low productivities to fully mechanized, safer, higher productivity methods, modernizing the recovery plants and operating practices to increase throughput and recovery, instituting just general operating cost reductions. And one of the things we do specialize in is direct relationships with customers. That would be the smelting business. And rather than using traders, we actually go out and know the smelting business in many metals quite directly through personal relationships and can negotiate straight with them. And then finally there's brownfields exploration. That is the exploration around the mine for more ore of the same type that hasn't been seen before. These mines typically generate cash flow from day one, which we reinvest until the turnaround strategy is complete. And once it's hitting on all cylinders, we find a way to return cash to shareholders. So we've done that in the past by buying back shares, by redeeming warrants for shares, and by instituting dividends. For the years 2012 to 17, we were actually returning 6% of trailing quarter revenues to our shareholders. I'll explain in a minute. We've had a flooding incident in one of our mines that has temporarily restricted production from there. And in order to deal with the cash flow limitations from that, we've had to suspend dividends. And the idea is we repeat this cycle over and over again. We've done this, again, the full cycle of buy and turn around 3 times in the last 7 years. What have we ended up with in this period of time? Currently, we have our emerging core asset in Sweden. This is the latest acquisition we made in late 2014, and just about 2.5 years on, in the second quarter of this year, the turnaround became apparent. So this one is now quite self-managing and generating its own breakthroughs. The first asset we acquired was Costerfield, gold antimony underground mine in Australia. And this one is actually a good example of the kind of opportunities we seek. This is the first mine in the portfolio, and actually the owner of this mine, which was a large coal company based in British Columbia, found itself with a stranded asset on care and maintenance with no resources, no reserves, no customers, no employees, and they wanted to get rid of it. They gave us the mine and $3 million to reopen it. It was on care and maintenance coming out of the global financial crisis. And ultimately, they sold that 2 years later for $30 million. So we provided them a value-adding exit. But meanwhile, we got into production as a recognized producer just in time, to be the only bidder on our second mine, which was Cerro Bayo in Chile. Again, that was another mine coming out of the global financial crisis on care and maintenance. That one we were the only bidder on, and again, bought it for pennies on the dollar, about $1 million cash, some paper, and about 100,000 ounces of silver to be paid out of production. Promptly reopened that one, and then there's Björkdal. That was a mine owned by a public company in Canada, basically breaking even, but not doing well enough to support the previous parent company. We bought that, got rid of the overheads and the distractions of the previous owner, and are now just focused on that mine. At the moment, Cerro Bayo is on care and maintenance. We had a flood there. We're mining in and under and around a lake, and one of the mines that we thought was least liable to experience a flood, about 100 meters from the lake shore, actually experienced the shore sliding away and creating a new bay in the lake, which flooded the lake. And it did kill 2 people. And we do have to re-permit this mine and prove that to ourselves, first of all, and to the Chilean government that we can reopen it safely. These widely dispersed operations are supported by technical experts around the world. We're kind of unique. We do not have a corporate headquarters. I work out of my house in Philadelphia. Greg here is in our investor relations office in Toronto, where we head up our corporate development. But we have our chief metallurgist in Perth, where all good metallurgists live. That's the world center of metallurgy. We have a chief geologist is in Brisbane. We have our CFO here in London, who gets all our financial back office work done in India. So this is a very low-cost structure. As you'll see in a minute, I believe we are the lowest cost corporate overhead per ounce gold producer in the world. It's about $30 an ounce. And that does not change when we add a new mine to the mix. So one strategy for discounted acquisitions is merely to acquire a mine, and most one mine companies spend the same $4 to $5 million a year on overheads that we spend, and we can just wipe out that extra cost. Again, we've done this 3 times since coming out of the global financial crisis. You can see here the gold price cycle here. There was it was low coming out of the financial crisis, high for 2 or 3 years, dropped back down, and as we all believe, it's starting to come back again. We bought our first 2 mines, Costerfield and Cerro Bayo, coming up out of the crisis. Refrained from acquisition in 11, 12, and 13 when the price was high and asset prices were high. Concentrated on optimizing the operations, paying down debt, exchanging warrants, and beginning that revenue-focused dividend. As the gold price came back down again, we made another acquisition of a development asset in Chile and the Björkdal operating mine in Sweden, and again got deeply discounted prices here. We've been growing our revenue. We've been one of the downsides of turnarounds is that between acquisitions, the organic growth has been already completed, so we actually grow acquisition to acquisition. We've grown production in black here, consistent with growth in reserves. So we haven't overinvested in the reserves and producing them faster than we can discover additions and acquire new reserves. Again, here, over time, you can see that the sustaining capital per ounce of production has come down. Again, we're buying $100 or $200 million investments in mining plant and infrastructure for pennies on the dollar, and as we restart them or optimize them, we are catching up in sustaining capital, but overall our rate of capital spending is quite low. And again, as we grow, getting lower and lower per ounce. And here is our overhead spending. In the acquisition year of 2014, we had temporarily higher than our normal $4 to $5 million a year. But again, after Björkdal, our actually overheads were lower, absolutely, than before. And as a per ounce of production, again, consistently declining per ounce. So it's a virtuous cycle, increasing momentum as we add more operations to the mix. And we tend to buy at below average prices. So for the last 5 years, the average acquisition cost for producing mines per ounce of gold equivalent has been about $225 or $250 an ounce for all the ones done throughout the industry. We bought Cerro Bayo and Björkdal for about $150 or $160 an ounce, and have added discoveries of brownfields, new reserves for about $50 an ounce. So our corporate average is about 80. And so that's about a third of the industry average. It's quite an advantage. Our balance sheet as of last quarter was quite strong. We'll talk about the share price in a minute. But we've got a very clean share structure with about 5% of shares outstanding as management stock options, and that's pretty steady year in, year out. So fully diluted shares about 470 million. We are in the penalty box in terms of market cap right now at 142 million Canadian, and we'll talk about that. We have about 25 million in cash and 40 million in interest-bearing debt, which we've restructured for lower carrying costs in the last 6 months. And we have 25 million available on our revolver, undrawn, which we're planning to use for investing in our ongoing operations and acquisitions. We have major shareholders who own us primarily for our recognized track record in buying and turning around. They were not disappointed when we had to curtail the dividends earlier this year. And in fact, all the top ones have been buying up as our share prices come down. And the result is really over the last 9 years, creating and delivering superior value for shareholders. Our total shareholder return, is in the gold line. And you can see we climbed up to quite a high value and have been in the penalty box for the last few quarters. But even so, in dark blue is the peer index, and in light blue is the gold seniors, the Newmonts, the Barracks, and so on. And we're significantly, even at the bottom of our trough, significantly outperforming the gold market in general. So we would argue that we are a superior investment here. So the turnaround you can see just emerging now at Björkdal. This is the kind of graphs we track all the time. The mining rate is about steady. Mining costs per ton have come up a little bit, but that's because we focused on grade control. This is a low capital focus on mining better grade material. And as you can see, our mining rate has been steady, milling rate's been steady. Both costs per ton numbers have come up, but we're producing roughly 50% higher grade material to put through the mill. So especially in the last 2 quarters, we've had 2 record production quarters in a row, and the cost per ounce of gold is coming down as we expected. This is continuing this quarter, and we expect to end the year with the 3 consecutive best quarters since we've owned the mine. We are seeing emerging new ore types in the mine. You don't need to know what a skarn is. It's an altered limestone. And what we're finding is there are limestone bodies all around the mine that were previously unrecognized as containing high gold grades. And we're finding high grades throughout. We've actually mined into this one and proven that there's grades of 4 to 5 grams a ton for continuously bulk mineable tonnage. So this is a very unexpected discovery from the perspective of the previous owners, and bodes well for continuing our improvements here. Costerfield was our first mine, and you can see the same trends. So mining rate here has gone up over time. This is basically Q4 2009. We've doubled the nominal size of the mine to about 425 tons a day, and reduced the mining cost from a high of roughly $300 a ton down to about $150. And meanwhile, the milling rate has gone up to match the mining rate. We did this with no capital, and the milling cost per ton down. Costs are very well controlled here. What the variable is grade. We understand grade variations very well. In the last year or two that we had very high grade material coming through the mill, the rate of gold production was quite high, and the cash cost per ounce of production was very, very low, in the $500 an ounce range. We expected grades to drop more recently, and they have. And as a result, the rate of gold production has come down, and the rate of, or the cost per ounce has come up a little bit. Still profitable, still funding its own exploration and development. And in fact, the next ore body is showing up in our current drill holes. Here's our current mine. This is a plan view. Our current mine is down here in what's called the Cuffley Lode in Augusta. We have just announced that we're going to develop the Brunswick vein right here, and are now in the process of digging a tunnel about 500 meters from the existing mine to the new mine. And 500 meters beyond is the old Costerfield and Kendall mines. In cross-section here, there's a very high-grade potential ore body showing up, which we've intersected in 3 drill holes, and we're drilling this right now. And in long-section view, BB, you can see it's several hundred meters in length, a couple hundred meters in vertical dimension. This presages a return to the high grades as we are mining in 2015 and 16. And for a mine with no reserves that we've been mining continuously for 7 years, that we were given for paper, this is already delivered. It's 3x returns to us, and could go on for many, many more years. Cerro Bayo is the second one we acquired. Same kind of trend as Costerfield, raising the mining rate. Again, a restart from a care and maintenance phase. Very well-controlled mining costs. Milling rate rising, well-controlled milling costs. And basically silver production here, varying depending on the silver grades. And the silver cost at the best was about $5 an ounce, down from the previous owners $15 an ounce. And the issue is we ran into trouble here with the flood and had to stop production. We have 8 permits we need to reopen this mine, and probably about a 12-month period, or maybe a little more, to get those permits. The value drivers for the next few quarters is really looking at Björkdal's continued good performance. We'll be investing in an ore sorting machine there to the tune of about $10 million, which can upgrade our low-grade stockpiled material in grade by about 50%, from half a gram to a gram, and add 3,000 or 4,000 or 5,000 ounces a year to our production rate at very low cost. And we'll have a reserves update here. We expect another mine life extension to well over 10 years of life. And at Costerfield, we announced here development of the Brunswick. We'll have first ore coming out in March, and the end of that capital development here in about October. And hopefully, as we go through, we will have good exploration results on that next ore body and be able to continue development into the future. So why should you invest in us? One is we are in the cash flowing phase of 2 of our assets. Our third one that's on care and maintenance needs $15 million to reopen, which we have the cash to do when we get the permits. And we are really now focused all hands on deck on the next acquisition. Even at our low share price today, and the low share price actually values the company at less than the net asset value of Björkdal all by itself. So you can actually get Björkdal on sale if you bought us at 30 cents Canadian today. But we're actually focused on the next acquisition, finding another accretive acquisition whose turnaround cycle is ahead of us. And as we bring that back to market, we can again get back into the business of returning cash to shareholders through dividends and share price appreciation. So on that, I'll take questions.
So questions, anybody? Gentleman just down here.
Thank you. Very interesting. You seem to your income depends very much on the price of gold, yes, whose price depends on trouble in the world. Have you ever thought about evening it out by, say, taking on mines that produce industrially useful metals like platinum, palladium, cobalt? Or is it just
Okay, so there is, we would love to have precious metals mines with byproducts, base metals byproducts. So for instance, Costerfield, actually half the value there is in antimony. And antimony price cycle is a little bit offset from gold. So there's a natural hedge there. And we have silver and gold mixed at Cerro Bayo. We would love to have other mines with that kind of byproduct mix. But actually, when you really make a study of metal prices, the most important correlation with gold price is actually copper price. They are not counter-cyclical at all. And in fact, they're both a function of GDP growth. Now, there are disruptions with world crises and speculation and fear of interest rate changes and so on, but actually that is when gold diverges from copper a bit. But in average, when the world is prosperous, it can afford to buy gold as a hedge. And when the world is not, people are selling gold to live or to manage their needs for cash. So it's actually not as complicated as people would make it seem. And in fact, we have a reversion to mean pricing strategy, which keeps us honest, so that when gold price was down at $1,000 an ounce in the global financial crisis, and all the mining assets were priced, like the end of the world was coming, that's when you buy. And you stop when gold is 1,400 or above, because the risk is all on the downside. And as long as you keep that price cycle in mind, you'll be a contrarian investor and do all right in average. And as opposed to being susceptible to buying high when everybody's in a frenzy and selling low when everybody's depressed.
Question over here.
I have one question. According to your graphs you have shown, your acquisition was at a record high in 2014. Is it because of the metal prices or any other reason?
It's because of, well, actually this was, Björkdal was you mean the dollar per ounce we paid for it? Is that what you're meaning?
Yeah, it was a record high, your acquisition in 2014.
Right. So that was a public company we acquired. The others were trade sales from majors that they were non-core assets. So it was a public company. We had to offer a price that was of interest to their shareholders, so their shareholders would vote to take it. That was a mix of $50 million worth of Mandalay shares, and we added some cash to it to keep the share count down and make sure that it was accretive to our own shareholders. And we were paying for some of the upside we saw in terms of exploration potential and production growth. So we shared some of that with the shareholders of Elgin Mining, which owned the mine at that time.
Mark, thank you very much indeed.
Okay.
Thank you. Thanks.